Perfect. I have my fourth speaker who just joined us, and we are good to go. Okay. So good morning and good evening, ladies and gentlemen, and welcome to our second FinTech Friday session of 2023. My name is Karyl, and with us today, we have an amazing panel of experts for a great discussion. So before we start, just a kind reminder to keep your microphones on mute and to rename yourselves to include your name and institution name so that during the Q&A, we can identify you clearly. Please also keep your videos off unless you're one of the speakers so that we minimize bandwidth. So access to credit remains the biggest gender gap in financial inclusion. In fact, prior to COVID, the gap was estimated at $1.9 trillion. And so imagine what that number would be right now if it were calculated again. There are several causes for this gap, namely women having thinner files, lacking credit history and business records, the need for a guarantor or for collateral, as well as unfair algorithms or biased decision-making processes. Alliance research in 2020 and 2021 found that while fintechs are well placed to tap into the women's market, they are largely overlooking it. Often, they are unaware that there is a women's market with distinct needs and preferences, and their drive to build the biggest business the fastest possible way to biased data points that is not fully representative and algorithms. And then solutions and algorithms built on this data will then lead to biases against women. So our research found that the biggest glitch is in credit and lending is bias in underwriting algorithms, including criteria in which women are structurally disadvantaged, like education, income levels, yet variables that have absolutely no bearing on the repayment rate. So by removing such biases in the credit algorithm, lending fintechs could increase gross margins by up to 20%. So our session's objective today is to look at the inherent gender stereotypes and unconscious biases of a gender-neutral approach in credit and lending, and to hear firsthand from fintechs that have either directly addressed these biases through various gender-differentiated efforts they've done, or that they have put forward solutions that can be leveraged by third parties, both fintechs and banks, in addressing them. So I'd like to welcome my panel of experts, Reinier Masters, founder and CEO of Nikel, Sanjay Uppal, founder and CEO of Finbots, Maria Adelaida Molina, COO of Juancho Presta, and Munmun Nath, CMO of Union Digital Bank. So if I can please ask you to introduce yourselves and your companies in 30 seconds. So Reinier, why don't we start with you in the order of the pictures, and then we can move into our conversation. So, Reinier.
Thanks for having me, Karyl. My name is Reinier Masters. I'm the founder and CEO of Nikel. Nikel is a digital lending solution for banks focusing on Indonesia, but we do a couple of things outside of Indonesia as well.
Perfect. Munmun?
Hi, everyone. Thank you for having me here. I'm the CMO of Union Digital Bank, which is a fully digital bank based out of the Philippines. And our mission is to be the primary bank for credit for the underserved communities and be a responsible and sustainable lender that elevates people's lives. So that's about me and my company.
Perfect. Thank you. Sanjay?
Thank you for having me. A pleasure to join this esteemed panel. I'm Sanjay Uppal, I'm founder and CEO of Finbots.ai. We're based out of Singapore, and we are a fintech firm. Our primary product at this time is CreditX, which is an AI-powered credit modeling system. And the topic that we're going to discuss is obviously close to our heart because we're working with some of our clients who are able to use our product and enable, de-biasing their credit models, and be able to reach out to a really wide market. And, we'll be happy to share some of the success stories we've seen in our clients.
Perfect.
Thanks.
And Maria?
Hello, everybody. I'm very pleased to be here with you today. I am Maria Molina, COO of Juancho Presta. We are a fintech dedicated to offering microcredits to people from the low level of the pyramid. We are we are looking forward to generating inclusion possibilities to people who's not been accessing to the banking system. So thank you.
Perfect. So I think we have a good overview of the kind of people we have with us. And so please, during the call, whenever you have questions to our panelists, feel free to start putting them in the chat box and we will address them, hopefully all of them. So Reinier, I want to start the conversation with you. So I want you to kind of maybe give us a quick overview of what Nikel's credit and lending scene looks like when it comes to access to finance, in particular, to women entrepreneurs, obviously.
Absolutely. So we offer digital lending solutions to banks, which means that we help them on both the analytics and on the full end-to-end lending digitally within Indonesia. And so in doing so, we look at various segments that they have. And one of the big segments that a lot of the banks are now trying to target more actively is women and women entrepreneurs in specific. And so we've worked with them on a program. And what we've now done is, together with USAID, DFC, and QFFD, and the Australian government, so a lot of governments getting involved, is to come up with a 3-step process to help encourage local banks to provide more lending to women. And that starts off with an initial training program, which talks about basically growing your business, but obviously also touches on access to credit and how to apply for a loan and those things, to the next step, offering them a loan, which is in part guaranteed by these governments. So the banks still have skin in the game, but they're de-risked slightly. And then finally, the third step is a graduation where these women entrepreneurs get a loan directly from the bank without any guarantee, et cetera. And in that way, we're trying to help banks provide more financing to women in a step-by-step approach.
Perfect. So Sanjay, I wanna move to you maybe to see it from a bigger perspective. So when designing Finbots, did you carry any research into understanding key behaviors women have with money and credit? And did that have an impact on how you designed your process?
Yeah, thanks, Karyl. My background was banking, so I spent over 25 years in banking, and that got me an opportunity to go and live and work in 7 countries and oversee businesses and a lot of others, and many of these are developing markets. One of the things that became quite evident through my career was the fact that we grappled with the traditional biases in our scorecards. And typically we were working with limited data sets. We were using the historical data, which itself is reflecting the bias. And the techniques we used, had an enormous amount of manual elements that went into trying to create less biased scorecards. And so I had the benefit of that experience and the challenges we'd seen, and also the opportunities that we were missing because of just the quality of our scorecards. And the other thing was, they just took enormously long time to develop, right? And once you develop one, you waited a couple of years at least before you refresh them. So I had the benefit of that. And when we actually went around developing our product, we were fortunate to work with a couple of really live cases. And where the chief risk officer actually told us, he says, I know that our model is biased because we have a disproportionately high decline rate for women applicants. And their focus was essentially on the kind of low prime to subprime borrowers, a lot of blue collar workers. And when we looked at the historical data, predominantly it was male borrowers. So when we were kind of developing our product and we used this as kind of a test case, it brought us some really good insights. One was that in preparing the data, we had to overcome the issue of the bias that existed in historical data that formed a significant part of input into your modeling process. And that's something that became core to our design, especially in terms of data treatment. So we've developed multiple techniques in there, which automates the entire process, but rebalances the data and is able to essentially compensate for data, especially when you're looking at the female borrowers, which has much lower representation in your training data set. The second thing that happened was to go and look at our modeling process. So the algorithms we were using and how we were using them, what we realized is when we're using the right algorithms with the right approach in terms of hyperparameter selections and the optimization process, we are able to dig down and even pick up patterns in the data, even when the representation was relatively weaker in the historical data set. And those have become core to our design. And what we have found working with that client, there was an enormous successful rollout of the new scorecards and what happened in the approval rates, and they went up quite immediately. We also saw this with another client of ours. This is in Africa, in Nigeria, and a large part of the customer base is essentially women-owned businesses, and these are front house shops and corner shops and small stores, etc. And again, the legacy limitations of just the classic kind of the variables they used in the models. With our product, what they were able to do was to use a much wider array of data sets and variables, and be able to confidently create new models. And the outcome over the last 1 year has been absolutely fantastic for them. So you're absolutely right. I think the opportunity to work with some really live cases and live market situations, etc., really helped us hone in our product.
Perfect. And I will come back to you because in layman terms, there are some things that I think I would want myself and maybe some of the participants to understand better, especially when you talk about wider array of data sets. But I want to now move to Maria and Juancho's experience, because Juancho's credit approval rate for women is actually slightly higher than that of men. And so your credit algorithm clearly is working with women. So what are some of the reasons behind this? What have you done?
Okay, first of all, we developed our credit algorithm for men and women. And to do this, we collected sex disaggregated data, and we designed the scorecards to collect data and assess risks that are different for men and women. And the company's internal processes were designed to be able to store and use data differentiated by gender. And then our predictive model assesses men and women in a different way. We evaluate variables with different weights and customizations for gender. We evaluate variables such as credit experience, debt level, past performance, credit utilization, demographic variables, advanced payment execution. Also, besides social demographic variables, we check the employment situation of the people, especially women also, and do open banking for people who is not employed. In Colombia, basically half of the people we receive applications from is employed, and the other half is informally employed. They have their self-employment status. So it is easier to be approved in the financial system when you are employed. And for people who are not employed, we do the open banking because in Colombia we have a population of 50 million people, and of those 50 million people, 33 million people have some type of a wallet, digital wallet, so we can go enter and see how their performance is, and in that way we can multiply the approval rate to when we are able to see how they are moving their money and the balance they are maintaining their account. We have the credit assessment models by gender, and once we contrast the credit approvals with the performance in the payment of the credits, we discovered that the non-performing loan results of women are better than of men, and women pay 20% better than men, and this is reflected. We reflect this also in our rates, the rates we charge them when they use our products, because obviously this behavior is not only for us in Colombia and in other countries. We will see that women are more cautious when taking a credit, and therefore we offer them a very more economic solution.
Perfect.
And also, I want to highlight something
Sure.
that is very compelling. And these findings are very interesting because we are located in Colombia, And in this country, women on average earn 75% less than men, and they have an unemployment rate of 500 basis points higher than men. And although they have these disadvantages, they have higher financial discipline and pay. And basically, we have analyzed this, and this is because they reflect more caution when seeking a credit, especially during periods of high interest rates and higher economic instability, like the one we are facing today. So basically, this leads to a higher approval rate in our company, where 60% of the credits are granted to women. Thank you.
Wow, that's amazing. And I mean, normally seeing those at least market data around women's opportunities being that unfavorable, it's so nice to be able to see that a fintech was able to see beyond that and really look behind the reasons and be able to produce services that are so favorable towards women, understanding the real actual behaviors, financial behaviors. And it goes to show that you can't really 100% depend on what the market really looks like unless you really study every single component of that. And I just want to ask a very quick question again, Maria, on that. You know, with all of this, the higher approval rate, 60% going to women, with more favorable approval rates towards women, with favorable assessment algorithms, etc., and credit features. So all of that, meaning now you are giving way more loans to women. The NPL rates, the non-performing loan rates, are still in compliance with your initial thought, and they are still favorable towards women.
They are 20% better than men. Men non-performing rates are higher than women in the different periods. 90 days NPL, 180 days, 360 days. In every NPL, they are performing better than men. Wow. In our records.
Wow, perfect.
And actually, we saw some data from Colombian market, and basically it is 20% better, the women performance and men performance in our company and in the country.
Wow, perfect. Thank you. Munmun, I wanna turn to you. So how are you in the Philippines at UD overcoming data biases when it comes to credit scoring? And do you rely on available historic data sets, especially after hearing both from Reinier and Sanjay and even Maria that this historical data is biased?
Yes, absolutely. So in my response, you'll see echoes of what Maria and Sanjay said, but I also want to actually start off from where Maria left off about basically women being better borrowers. And there's so much research and data available from global studies done on micro lenders, which show that women are more responsible borrowers, they're better at repayment, have fewer default and loans. And yet we are here discussing this issue that the credit gap for women still remains high. So there are three ways we feel that we are trying to overcome these biases in data. So the first is, as you mentioned in your introduction, that ownership of collateral has traditionally been one of the barriers for women. So in our bank, the credit product that we offer, it doesn't require any collateral. These are unsecured loans, and it doesn't require any documents either, because identity related documents is also a key barrier to access to credit in the Philippines. So that's one way. Second, as Sanjay was saying, we do use historical data, but that isn't the only input. We also look at a lot of alternative data in deciding the credit worthiness of our borrowers. We look at data such as mobile phone or wallet transactions, online purchases, bill payment behavior. But the third thing, what we do is, for all these alternative data points, we also look at whether there is any proxy. Are they in any way proxy of gender. To give you an example, profession, for example, you might think profession is a very general, neutral metric, but in a country like Philippines, 90% of the teachers tend to be women. So we look at every metric and how it's performing on the criteria of gender, whether it's in any way introducing any kind of gender bias. So we evaluate the model and the metrics to see whether the algorithm itself is fair, and we adjust it if we detect any bias in it. So yeah, those are the ways we are trying to overcome these biases in the traditional data.
Perfect. Thank you. That's great. So I see that, all of you are completely in line, basically, in what you're doing and in all different parts of the world. So, Reinier, I want to come back to you. And, I think we're talking about all of the challenges and the gaps, but let's talk about the main biases. So what are the most common biases that you've encountered along the way? And in particular, especially, obviously, for credit underwriting?
Yeah, so we built models for a number of the big banks in Indonesia and have collected data on more than 1.3 million SMEs. And in building models, credit models for them, both credit needs and credit risk models, we've also obviously analyzed their historical models to understand how they operated. And I have to say that, the gender bias, to be fair, is not explicit, right, in their historic model, but it is very much implicit. And it has to do with using metrics like income or tracking collateral or tracking how long have you been a banking customer, or those types of elements, which are really disadvantaging women. And what we've found is that on average, most banks still have a divide very close to 50-50 in Indonesia between women and male borrowers. However, the amount is a lot less. So women are getting less access to credit, and in line with my colleagues here on this Zoom, is the women just perform better, right? I mean, the data is overwhelmingly the case. So there's no deviation there. Indonesia is very similar to every other market, that the women are better at repaying, so lower NPLs, lower defaults. But not only that, but they also need a lot more credit than they're getting access to. So there's really an imperative to do more of that. So we work with that, obviously within the new models that we have, to really focus more on the transaction. So the incoming and the outcoming transaction and the saving capital, obviously not using collateral as much. So unsecured loans. Looking for alternative sources of collateral or evidence that there's something to corroborate the loan. So those things. But interestingly enough, one of the things that we found, and I don't want to go too much off topic here, but that, implicitly what you're doing when you're building a credit model is you're looking, can I trust the borrower, right? Can I trust that borrower to repay? And what we've actually found, we did recent research because we're building a training program for women entrepreneurs, is trust is really a two-way street. And as much as it's about the bank trusting the women entrepreneur, we've also found one of the biggest encumbrances to women getting more access to capital is women actually trusting the bank. And so communicating about the loan and helping women understand what the implications of the loan are and how it works, and getting them comfortable on various metrics associated with the loan, is equally important to giving better access to credit. I'll pause there.
Very interesting food for thought, by the way, to really see that there's such a more qualitative component to this whole equation that I think is quite overlooked a lot of the time. So thank you for that.
Yeah, maybe just one small add-on. This is particularly important in fintech. So our research showed that women entrepreneurs have serious questions with financial institutions, but especially with fintech institutions. We have a lot of reputation to mend, so to speak, because of damage been done in the past. Yeah.
Very interesting. Thank you for highlighting that. Sanjay, a while ago, so you talked a lot about what you've done and what you've seen from your experiences and how you've integrated that. So obviously the biggest funnel blockage at the approval phase is biased credit algorithms, right? So they reject more women than men, given the usual features they look at. So how have Finbots addressed this issue, and what have been the results to date?
So, a product is a model building platform, which is organizations use our product to build their own credit models. And what we have done for that is, apart from the things I talked about in terms of what the solution does on data treatment and model development and optimization, the other thing is that we're completely data agnostic. So today, the client I talked to you about in Nigeria, they've actually got no historical data. So there's no credit bureau, or at least it's not very credible. But the second issue there is also that the bank statements are not a comprehensive source of information. A lot of the transactions are recorded in cash. And the third thing was that even financial accounts of those businesses are prepared once a year. They're kind of again a mixed bag in terms of quality. So in that case, actually, the lender has validated data of all these shops. They are buying FMCG goods, right, which they're ordering from the main distributor every week, every fortnight, every month. They've got the entire history of this data, and they capture it literally on a real-time basis. So you've got what is being ordered, what quantity, what price, are there any returns, cancellations, including the device data, because these merchants are using an app like you and I would use Amazon or a Red Mart in Asia or something like that. And they're using an app to order 50 soaps of this brand and 200 cans of this drink and so on. What we have found is that data has proven really, really valuable in terms of helping create a credit scorecard that delivers a very fair credit limit. And this business is actually, as I was mentioning, can't share the numbers, but has seen an amazing growth just within 1 year. So I think the ability to use data that's available and reflective of underlying business activity or underlying personal, kind of situation, no matter whether it's traditional or not, is proving quite robust. The other one which we recently worked with was on telco data. And this was a large data set. And, I'm talking about a data set, more than 500,000 records. We're talking about more than 1,600 data points. So you're talking about 800 million data points, more than 1,600 variables in that data set. And I think the quality of that model that came out was absolutely fantastic. So the other thing that happened in this is, the traditional models will have a small number of variables because that's what we could work with, legacy methods. What we find our clients are able to do is create models with a wider set of variables, and those, including the interaction between those variables, are able to capture a lot of nuances that their previous models used to miss. So I think a combination of how the model development happens, but at the same time, allowing the organizations to use the data that's available rather than say, well, this is what I need, and unless I have it, I can't create a credit model, has really helped. And the alternate data at times, actually very often, like I was talking about this client in Africa, has proven to be more powerful than any other traditional data in predicting creditworthiness of the borrower.
Amazing. Amazing. Goes to show you how much wider we should start really thinking about, how we do these analysis. So Maria, have you applied such changes within the way you work? So have you solved for these limitations that women have, or in accessing, having the data that Sanjay is also mentioning? So the lack of, and what Munmun also mentioned, lack of collateral, informality, documentation challenges, or historical credit experience and data. So have you solved for this as well? Does your algorithm take that into consideration?
Okay. First of all, for us, it's very important to know our customers, our clients. So the first thing we do is to know their demographic characteristics and needs to be able to design products that are attractive and useful for them. And we are focused on 3 segments of women. women with high school studies. Basically, they have basic education, and women with technical studies is the second, and the third one are professional women. Those are the ones who pay better, the last segment. Based on that, we design products and services. And for example, most of our clients, women clients, are young. They have dependents under their responsibility. They live in a family home or a rental home. They are employed mainly in the commerce, food processing, and healthcare sector. They receive the payroll in a monthly basis. Most of them will take a 24 months credit with us, and most of them live in the two main cities of Colombia, Bogota and Medellin. And they take credits to pay unexpected expenses, pay a family expense, invest in her own business, or pay another credit. And for them, it's very difficult to access a guarantor. Support them with the credit. They don't have this huge network. So we offer a guarantor service to facilitate credit access. Also, they value time because of their multiple occupations. So we provide a digital platform to ease the credit approval process and the disbursement of money. And so we approve the credit in basically 10 minutes and disburse it in 25 within the next 24 hours. And for the women who have no credit history, which is a lot of women who have that situation, we do the open banking, and also we approve the credit, and they start creating history in the financial system, which is going to be positive for them. Also, we provide some clips in our social networks to help them with their financial planning and financial habits, so they get better in knowing the financial system and the management of the money. So yes, we try to, and of course, for the documentation, we don't ask that much documentation. We are just asking for the identity number, the name, the cell phone, address, and then we use that data to be able to check in our external partners, so they don't have to submit that much documentation or waste a lot of time trying to get a credit with us. So we try to be a solution that is very practical for them. We help them start creating their history in the financial system.
Perfect. Maria, I want to come back because you mentioned twice open banking, and I just want to make sure that all of our audience is aware of what that means. Can you maybe quickly give us an idea of when you say we have open banking for these women who do not have, the specifics that we're looking for, what that actually means?
Okay, so for people who is not employed, who we cannot see if they have their social security paid, so we connect with the banks and to see how the bank movements are doing in the population we are evaluating. So in that way, we can know how much money they receive in their account, how much money they spend, and how their balances are performing over time. So in that way, we can know they have enough money to pay the credit back. And we have some allies to whom we connect, and they do that for us. So the idea is to obtain information, deeper information if in the future, but now we just found out if the balances are the appropriate ones. But I think that gives us alternative data from the one that usually we receive from the bureaus or from the credit bureaus or from some specific demographic variables that we double check. So with that variable of open banking, and we think we can include people who's not formal in the financial system and the bureaus system.
Thank you. And actually, I want to stay with you just one more because it's right on what you're talking about. You mentioned the guarantor service. So we have a question that around that as well, because it's very interesting to really hear about that. How does it work exactly?
We, in Colombia in general, people is going to ask for a credit and they say, please give us a guarantor to support you if you don't pay the credit. These people is not able to do that. So we offer a service. It has a cost, but we offer a service where we get some money and we create like an auto insurance. So if they don't pay us the appropriate money they have to pay us, we just go to that collateral and get a specific amount for each credit that was not paid properly. And so the idea is to offer possibilities for people who do not have guarantors. So we do this mechanism to be able to finance them, having the risk, the proper risk actions inside.
Interesting. Thank you. So Munmun, I mean, you talked about collateral-free unsecured loan and no identification required. So I'm wondering, as a former banker that gave me a heart attack, so how does that work, and what are initiatives do you have in place to increase women's access to credit?
Right. So what Reinier said earlier, that really resonated with me, because while we are talking a lot about, when we talk about the barriers to access, we talk about credit models, but that's really the bottom of the funnel problem, right? Like as a marketer, I also look at the top of the funnel and how many people are actually even coming to us to apply for a loan. So we also, to answer the second part of your question first, we really focus on how we can create gender intentional digital marketing, and sales and servicing processes that will help us gain the trust of women, attract them more so that they apply more to us, and how we can also retain them and get them to repeatedly borrow from us. So it does require not just a change in process, but also a general creating that building employee empathy in the whole company, that this is a problem and we need to be mindful of how we can service women better. So the other thing that Reinier mentioned, and we also focus on a lot, is around women have some specific concerns when it comes to digital lenders. What we have found from a research, that women generally tend to they adopt fintech products if they find that it complements what they have experienced offline, and they may have more concerns about security when it comes to digital lending or digital finance. So we spend a lot on understanding these specific concerns that women may have, and then create education programs, as Reinier also mentioned, that they do some initial trainings. We also focus a lot of community-based education programs, so we can create more awareness of how we are a trusted and responsible lender. That's one of the biggest challenges in Philippines, that there are a lot of digital lenders who have predatory practices, and women are scared of digital lenders because of that. So we try to create that awareness and trust in our services, that we are not going to harass them. We are not going to message everybody in their phone list if there is a delay in payments. So that forms a lot of crux of our focus around being gender progressive lender. And what you were saying earlier, that gave you a heart attack. I mean, I think we are able to do that, and a lot of digital lenders are able to do that unsecured document-less loan because of our reliance on alternative data. So we are an emerging lender, but I think the biggest name in this space is Tala, which operates out of 4 countries, and they have a similar model where they're able to score you using the metadata of your mobile phone, and they're able to risk-based price the loan that they're offering to you, and it gets instantly disbursed. to the account as well. And because we are a digital bank, in many cases, we are able to auto deduct from the savings accounts or the wallet that they have with us, which also helps with our collections and repayments. So yeah, I hope that answers your question.
Yes, it does. Very, very interesting. Thank you so much. Reinier, so what are the techniques do you have? I mean, you talked about, the things you've done, from education to start with, and then how you've handled those implicit biases and even the building trust from an organizational perspective. What are the techniques do you have in place to mitigate biases that you encounter?
So I think most of it is already been mentioned. I think maybe just highlighting the guarantee, we have we benefit from a guarantee from the government, which allows us to make it easier for banks to lend, since in our case, 70% of the principal is de facto insured. So that encourages them. I think the one thing that may be worth touching on as well is what we call closed loop lending. And what we do there is we finance merchants on technology platforms. So the bank will provide a loan to a merchant on a technology platform. That merchant will then get access to capital so that they can buy whatever goods and services, or goods typically, that they want. And they'll sell those goods on that platform. And the money will be collected again on that platform and will be automatically deducted to pay for the loan. And that obviously reduces the credit risk and also reduces the need to collect all sorts of information on the borrower because it's already known, because they're active on the platform. There's already a track record on that platform. So there's just a lot more security. And we found that in those systems, the loan performance is just is phenomenal, right? Is very, very good. And I mean, works well for encouraging lending towards women, but also works well for encouraging lending to folks that aren't getting access to capital as easy. So maybe just to contribute that as one way to just debias. One thing that we find really important fundamentally, though, is that we get banks into this lending process. So for us, we really try to make sure that the capital is coming from banks and that banks are in some way exposed to the underlying credit risk so that they can build up the track record. Also, that lender becomes an official lender of record that gets recorded within a credit bureau. And that way we're hoping that these borrowers can build a credit track record, which can be used going forward. Right? So that way we break the cycle. Otherwise, we help them temporarily, but as soon as that program is over, they haven't really improved their credit rating at all. So that maybe that as a final thing.
Yes, and so before anything else, we just got a question from Cristina Lopez about the platform you just mentioned. So could you maybe share the link or more information about that platform? Is it very regional focused or localized for a specific country, or is it possibly open? And can you maybe just put the link as well in the chat for that platform?
So we as a company do that with a number of technology companies. So we don't do that with just one, but we do it with a number of merchant financing operations in Indonesia. And happy to share.
So they're very localized for Indonesian market?
Yeah, just Indonesia. Yeah.
Okay, but maybe if you can share those links, simply because it might give us an idea of the kind of platforms we should search for in other countries as well to work with in similar fashion. Very interesting. Sanjay, I'm actually going to take Inez's questions and maybe Sally's question to you rather than mine. So first question, you mentioned inventory data from FMCG. So how are you able to access that? You're on mute.
I'm on mute.
Yes.
So how they're able to access is because the primary distributor who kind of distributes for most of the brands has an app that's used by these retailers to order the supplies. So they're essentially just opening the app, ordering the supplies for whatever they're running short on, and that data is being captured. So essentially the data is being captured is around the usage of the app and various elements of that app that's being used. But number two is the order history, which includes the geolocation data, the time data, etc. But also within that, a huge amount of detail on the purchase. What kind of products are being purchased by these retailers? What volumes are you seeing cyclicality in that? Are you seeing, the volumes go up and down? Are you seeing orderings and cancellations, etc.? And that is being used, so when they started lending, they essentially used that data set to find the right from using our product, use the create a model that, finds the right correlation between the actual purchase history along with the performance, the loan performance targets. And they found that that was served as a really good. So the quality of those models is consistently very, very high quality, high accuracy, very stable models. So the advantage they have is that, through COVID, when these retailers weren't able to order the supplies, they had no, the distributors like, how do these guys order the supplies from me, right? I've got all these stocks. And they developed their own app, which they then, made available to the retailers. And it was quite interesting when they started looking at, well, how do we use your product to develop our model? And they're still looking at traditional data. They happened to mention, by the way, so we just actually asked, I remember, so how does the ordering happen? And they said, oh, that happens through an app. And it's like, where's that data? And they're like, yeah, it's sitting somewhere. And we said, okay, let's try and dip into that. And that just was literally a gold mine they were sitting on. They didn't even know. Now, the beauty is that that data is refreshed literally in real time every day, right? As these guys, the retailers get in an order. So at any point in time for their credit team, if they want to refresh the models, they want to, just check, create new challenger models, they've got absolutely, latest data available with them. In the purchase history data as well as the loan performance data, which they're able to combine and create new scorecards. So that's been really fortunate, I think. And I've seen that model come up. So I've seen a few other markets where, retailers are now using these apps. And I've seen that in Vietnam also. I'm also seeing this, somebody we spoke with in Pakistan and doing the same. And I think I was telling them, that becomes an enormous quality data because it's verified data, which gives you huge amount of value when you're building your credit scorecards.
Interesting. And so just to kind of stay in that loop, so that FMCG company is actually your client. So they wanted.
So the FMCG is actually the primary distributor, but they've got their own fintech.
They've got their own fintech. Okay. But because for them to be able to share that data with you and for you to do so, there is a partnership.
Actually, we're not accessing the data, so our platform is deployed in their environment and they're putting the data into it and using it. So we actually do not get to see or use that data at all. But the example I gave you in Vietnam. Now in Vietnam, this lender actually doesn't have, they are not the distributors. So what they're doing is they're working with the distributors and using that data to possibly develop credit scorecards. So it's a win-win, right? There's somebody who wants to lend and make sure that that's a business opportunity there. The distributor finds that, if these retail shops are able to get leverage or get funding, they're able to carry more inventory than they normally do. So, with our client, the classic situation was with all these retailers, they were buying on cash. And what that meant is, let's say they bought $500 worth of $300 worth of supplies. 2 weeks down, when the customer walked into the shop, they didn't have the inventory. So this program has seen the inventory levels and the sales level go up across their retail network.
And then Sanjay, just one last, because Sally had asked a question as well initially. So you talked about all of these data points in the beginning, and you mentioned 1,600 data points. So obviously a lot of ears popped on the call today. So what do you refer to when you talk about 1,600 data points? Who has that, and what are we talking about?
This is the telco company themselves. So they, for both prepaid and postpaid customers, are able to track the history, usage of the device across various metrics. So it's an enormously rich data, as you can imagine. So, and I'm not saying, I think I'm trying to remember how many variables went into the final model. But the point is, you had that available there that allowed, enormous richness to be harnessed into the model development process and get a really high quality model out of it. So a lot of the data, obviously you've got the demographic data of the mobile customers, then you've got the device data, you've got the device usage data. You've also got their account data, right? So whether it's prepaid or postpaid, in terms of utilization, whether weekly, monthly, and also the payment patterns. In prepaid, you've also seen, what kind of cyclicality you're seeing in there. When does it get topped up? How much it gets topped up? What is the average amount that's being used, and so on. So all that actually, gave some really good insights in terms of determining or being able to correlate credit worthiness. But you have to remember that this was for smaller value loans, right? So, but yes, worked very well.
Very good. I have a question here from Sofia Oliveira, and I'm going to address it to Maria and Munmun first. So how are your governments within your prospective jurisdiction? So the question is for all of you, reacting to such initiatives of improving women's access to credit, particularly on the legislative front. So have you had any contact or any feedback on this? So Maria, maybe I'll start with you.
Okay, our government is very focused on offering opportunities to what the president calls the popular economy. And he wants to offer possibilities to people who's not being involved in the financial system. So in the recent development plan, the government approved the open data and open banking regulations to be able to start using data. Basically, the data in Colombia belongs to the person who owns it and not to the banks. So the bank needs to provide the information to anyone who asks. So this is a new regulation that just passed. And so we are very excited to find new possibilities to evaluate the performance of people, to be able to generate higher inclusion of people who's not within the financial system yet. Also, the government is creating some programs to offer credits to poor people. So we are in contact with we are already in contact with some of the administration agencies to be able to participate in these 1 billion credits who is offering the government, and see what's going to happen with that. But I think we have interesting possibilities regarding the popular economy.
Amazing, and that definitely helps with the open banking efforts that you're trying to put in place for some of the people, for sure. Munmun, I'd like to hear from you on this as well.
Sure. I think the Central Bank of Philippines is a very progressive regulator, and in my opinion, the biggest step they have taken, which benefits women, is to give out licenses, 6 licenses for digital banks to operate starting last year. And why I feel that's the biggest step that they have taken, because if you think about it, going to a physical bank branch is one of the key barriers in accessing financial services, right? Especially for women, because it might take them away from their paid labor or childcare activities. So that's one of the ways, at least from my lens, they have been very progressive and benefited. But apart from that, one of the other things that they do is they ask all the banks to report gender disaggregated data so that they can monitor the progress around how the gap between men and women is being reduced through our lending and other financial services. They have introduced a new policy around standardizing the business loan applications so that to reduce the number of forms or the variety of forms that people, and especially women, have to fill in when they apply for loans. And they're looking at all the other policies from gender lens. They have created this gender focal point system as well, in which all BFSIs can participate in. So yeah, these are some of the initiatives that I have seen, and there'll be more to come in the coming years.
Amazing. So I want to ask maybe a question. So in case the audience has any questions, please put them in there. We still have 5 minutes to pick the brains of our 4 lovely speakers. So my question is, so we talked about all of the different, challenges in terms of accessing credit through the algorithm biases or the different types of biases that we have in place from an underwriting and a review process. But have you seen any gender differences or barriers of behaviors to uptake financial services in the first place? So you talked about, Munmun, for example, now the physical requirement of having to go to a bank. So that's one of the different challenges. So it has nothing to do with algorithm bias or the requirements from a documentation perspective, but it's still a challenge and it does affect access to credit. So have you seen maybe any other behavioral differences in your experience? So whoever wants to raise a hand first.
So maybe just one to add, because we recently did market research on this in Indonesia. One of the things that startled me when we looked at it is we are focusing very much on educating women on getting a loan and the process and all those kind of things. What we discovered is actually it's equally important to educate the man, because a lot of times that turned out to actually hamper the woman getting a loan, because she would go home, for example, consult with her spouse, and that individual would not be familiar necessarily with the loan and would therefore dissuade her from getting a loan, etc. So one of the things that we learned about, if you want to remove some of the gender bias or barriers, is that it can also equally be important to also educate the men on the lending.
Interesting. Very interesting point. I have a question. Yes, Maria, you want to add something?
I wanna add that women economic condition is deteriorating after the pandemic. Men's situation deteriorated, but women deteriorated most. So they continue paying. Actually, the defaults in the consumer credits in Colombia has been increased. It has increased in the last year like 40% in the banking system, not for the fintechs, for the banking. So we need to be very aware of the changing patterns of disposable income in the population, especially women, because they are the ones who earn less money. So we need to be very aware of our credit algorithms to be able to react in a proactive manner every time we face change, socio-demographical change, or because of the high inflation rates, because of the devaluation of our money. So I think we need to be very proactive and responsible as financial institutions to be able to read what in advance what's happening and what's going to happen with our clients in order to be able to take care of the risk, but also offer opportunities to people. So in that way, we need to use new technologies, new algorithms, and be very aware of what's happening in the population to be able to make decisions in terms of the receivables, in terms of the approvals, in terms of the support we need to give our clients.
Amazing. I have a very quick question. We have less than a minute, but because it's very interesting, from Flavia, who's mentioning, we're talking about all of these new and technologically advanced solutions to really solving this problem. And Flavia can't help herself but think of the possible fraud that might come with it. So have any of you experienced any fraud with the methods that you're applying within your work, and how have you dealt with that?
We have oh, go ahead.
Okay, maybe Sanjay, you go ahead, and then Maria, and then we'll finish off.
So we did have a client who, with the legacy scorecards, was dealing with a disproportionate high instances of application frauds, or what we call first payment defaults, which means everything looked great. They approved the loan, dispersed it, and never saw that person again. And again, the scorecards were quite legacy, as you'd imagine. They were fairly linear, models based, and what we found is when they used our platform, which delivered, machine learning based models, within 2 to 3 months, they saw a pretty drastic drop in application fraud happening. And the idea was essentially what it was, that the scorecard was able to weed out a lot of those applications. And this becomes quite relevant because, as I said, the traditional models, which are more linear and
Oh, Sanjay, you're
Yeah.
freezing out. You're freezing out.
Oh,
We
sorry.
lost you.
Okay, is that better?
Yeah, now it's better.
Okay, sorry about that.
No
No, what
worries.
I was saying is, so with this client, essentially, one of the key things was the legacy models, which take months to develop and are refreshed only once in 2 to 3 years, and are linear in nature. They miss out all these nuances, and the incidence of frauds are there in all markets. And the idea really is, do you have credit scorecards that are able to capture these well enough? But what we see in our clients is, yes, in their books, they've traditionally had a fair share of credit frauds happening and application frauds. Yeah.
Okay, thank you. I know we're out of time. Maria, I want to give you 30 seconds to finish the thought you had.
Okay, we have a very strong client identification system to avoid frauds. We have avoided 20% of our digital applications we have received have been denied because of we have identified possible fraud issues. So I think for digital platforms, we need to be very strong in identifying the identity and validating with external entities that the people is complies with all the requirements you have. Okay,
Thank you very much. Amazing panel. I want to highlight some of the key learnings that I got from this discussion, just to share it and wrap up this discussion. So one, a lot of education that needs to go into it, educating women about accessing finance, but also educating men about having women be able to access finance, and then educating women also about the institutions themselves, making sure that the institution, whether it's a fintech, whether it's a bank, or whoever it is that is giving out those credits, is building the trust and is really transparent about all the ins and the outs that go in that credit process, and about the experience they're about to have with the institution, because that's critical as well in debiasing a lot of the challenges that we have. Two is a nonstop herd of the use of alternate data, really being creative in the way we approach what we look at when we talk about access to finance, to really shed away from that conventional and traditional thinking that we've been bred since the day we were born, but to really look into even having loans that are unsecured with no identification requirements, really looking at even the sector in which you work, making sure that we're not being biased towards it. And then being creative in applying open banking and the guarantor service that we got. So always trying to find or even collecting FMCG data and really basing a whole credit profile based on your purchase of soap, basically. So finding the data that you believe will identify and will reflect the quality of credit worthiness and your repayment possibilities is so many. And so really being data agnostic in the way you approach all of these is definitely important. And then closed loop lending, working from a merchant perspective, with different platforms, looking at partners, having a clear understanding of the economic situation and what's happening on the market is really crucial. I thank my 4 speakers for this very insightful discussion. I hope this will inspire many of you in my audience to really go back and review the processes you have within your own institutions, or if you have people within your own network, to really share how we should start thinking differently and doing things differently to really be able to close this gap we're talking about. Thank you so much. I know for many it was Friday evening, and so I'm very, very grateful, and have a great day, afternoon, and evening, everyone. Thank you so much.
Thank you for having us.
Bye-bye.
So good. Bye.
Thank you. Bye-bye.
Bye-bye.